next topic, in which it is the asset allocation strategies that work. And our speaker for this topic is the former managing director and co-founder of Manimax Philippines, the Asia's fastest growing financial comparison website. He has also worked in some of the largest M&A and capital markets transactions at Morgan Stanley in London and Dubai, who's specializing in the technology sector. He also worked with Nova Founders Capital, an internet-based company specializing in financial technology. Let us all give a round of applause to the co-founder and chief financial officer of Carabao Capital, Mr. Jorrit Koop.
Hi everyone.
Hi.
How are you doing?
Good.
Yeah?
Yes.
I like the energy in the room. It's perfect. Very good. Excellent. Okay. While my presentation is being set up, I would like to quickly introduce myself. So indeed, as was announced, I am my background is investment banking. I used to work at Morgan Stanley in London and Dubai for a few years. After that, I moved to Asia because I really felt that dealing with large companies and dealing with the CEOs of the largest companies in the world is great, but at the same time, where is the real change happening? Where is the real driving of the future happening?
Asia.
Exactly, it's Asia, correct. So that's why in the summer of 2014, I took the plane to the Philippines. No, to Hong Kong. To Hong Kong. I found out that's also not where the future lies. The future lies here, in the Philippines.
Yeah.
That's good, isn't it? So, what happened afterwards? I set up indeed the most successful financial comparison website of the Philippines. So how that works is, you go online. Let's say you want to avail of an insurance policy for your car, for a credit card, for a housing loan. You go to Moneymax and you basically check what is the best product that you can have, right? So you can even be helped by phone. You can buy the items directly on the website. It's very simple. So while doing that, it was quite successful. Within a year, we grew to a lot of people. When I left, there were around 50. And afterwards, I had the feeling this is a great project, right? This is really something that can work very well in Asia. These sort of stories and these sort of projects. But what is actually the biggest opportunity here? What do you guys think? What is the biggest opportunity in Asia in terms of business and in terms of, internet, capital markets, real estate perhaps? That is a question that's not so easy to answer. So that's why I started looking around with some colleagues of mine, and we basically had the idea and had a very strong conviction that SME financing is a very big opportunity here, and we think that is really something that's going to be very large in the next few years at least. So that's why you can here see my journey so far. You can see that I started with some colleagues, Carabao Capital. What do? Our biggest advantage is that we can literally credit score an application, we can review an application, we can understand what drives a certain business forward, what drives the need for capital in a certain business, and we can decide whether we want to extend the loan, yes or no. So imagine, if you are a small entrepreneur, you're a small business owner. So let's say you are someone who has a company that delivers water to an office, right? Is there anyone who owns a water company? No? Too bad. You could have been a company that we would have granted credit. We could deliver you that credit in literally 1 day. It only takes 1 day. In a bank, it will take you 8 weeks, 9 weeks. I'm sure some of you have experience in requesting for these sort of loans. It takes a very long time, if you get them at all. So for us, we deliver that credit very quickly. So I'm not here to speak about I'm not here to speak about Carabao Capital. I'm here to speak about asset allocation. What is right asset allocation? I'm not sure how many people of you have done an economics course in school. I see some fingers. It must be more. I'm sure that around 20% of you have done economics at school. Still, even if you have done economics, it's not easy to decide where do you need to put your money. Or even worse, right? Where do you put your client's money? How many of you are financial advisors? Alright, that's at least, I would say, 40 to 50%. Great. So the question that you guys ask yourself every single day is, how do I make my client richer? Is it right? Okay. So I am here to not to provide you the final answer to that. That is not possible. Otherwise you could retire tomorrow. I am here to provide you a framework, and I'm here to provide you with a start to that route. Okay? So, what does it consist of? Some theory. I mean, as the 20% that have done economics in school know, there is some theory on this, right? There's optimal asset allocation strategies, there is capital markets theory, there is financial theory, econometric theory even. And all of these things are, interesting, and certainly developed by people who are very intelligent, very smart, but at the same time, how applicable is that really in day-to-day life? If you are a financial advisor, you have to tell your clients, sir, ma'am, do you want to invest in stocks, bonds, real estate, startups, money market funds, anything else under the sun? You can't use that, right? You're not going back to the client and saying, yeah, no, according to the capital asset pricing theory of Modigliani and Miller, developed in 1964, you should invest 50% of your portfolio in a stock such as Jollibee. That's not how it works. So it's much more about a few other things, right? It's about managing the expectation of your client. It's about understanding what the need is. It's about tailoring it to the specific situation that you're in. So we'll talk about that much more than about the theory. But to start off, I would like to give a quick overview of very basic asset allocation strategies, okay? I promise it won't be too long. 5 minutes, not more, okay? There we go. So, if you look at asset allocations in a bird's eye view, throughout history of stock markets, throughout history of investing, throughout the history of capital, throughout all the economic history of mankind, there have been 5 rough theories, okay? 5 rough strategies to allocate money. What are those 5? It's very simple, it's very high level. First one, strategic asset allocation. What does this mean? It means that you go out with a view. Let's say there's 2 stocks in the whole world, right? Just 2 stocks you can invest in. Let's say it's Jollibee, and the other one is San Miguel. Okay? Let's say that the whole capital market, the whole world can only invest in these 2 stocks. Then it means that at the start of your investment horizon, so at the start, when you actually start deciding, okay, I have, 45,000 peso left, or let's make it a round number, let's make it $100,000 left. I want to invest this, and I want to spread this over these 2 stocks, and I have absolutely no idea which one is going to do better, so I'm going to invest 50% in Jollibee and 50% in San Miguel, okay? And my investment horizon is, let's say, 5 years. So then the first one, so the strategic asset allocation methodology means you are not going to change the weights. So it means you put at the start of the period, you put $50,000 in Jollibee and $50,000 in San Miguel. You hold it for 5 years, regardless of what happens. Regardless whether suddenly there is another fast food chain that's going to open up in the Philippines, regardless whether people decide that drinking beer is actually very bad for your health, doesn't matter, you hold on to them. Okay? Who is actually owning Jollibee and San Miguel? Are there people who are owning these stocks at the moment? Yeah, I see quite some fingers actually. Has it been doing okay? Yes, no? Happy with it? Yes, good. I see some fingers like this. Okay, perfect. I can imagine you would be happy with it, because if you would have invested in Jollibee or in San Miguel 5 years ago, you'd probably have more or less double or tripled your money. So it would have been a good strategy, 100%. Okay, then the second strategy is constant weighting allocation. All right. So what is the difference here? The start is exactly the same. So you start with deciding your weights, right? So let's say you still don't have any clue about whether Jollibee or San Miguel is going to do better. So you just say, all right, I'm going to put 50% in Jollibee, 50% in San Miguel. But then what happens? After a year's time, you check again, and you see that the $50,000 that you invested in San Miguel actually hasn't done so well. So let's say that people in the Philippines actually did decide that beer is unhealthy for you, and that the stock price of San Miguel has tanked with 20%. So suddenly you're not holding 50,000, you're holding 40,000 of San Miguel. But at the same time, the Jollibee stock has done very well, maybe, right? Maybe the Jollibee $50,000 that you put in first has now gone to 60. Because, I don't know, it could be that Jollibee has introduced a very healthy menu, right? It's possible. So, then what you decide, after a year's time, you check again, you say, alright, I'm now going to sell off 10%, or basically 20% of my holding in Jollibee. So 10,000 you sell off out of Jollibee, and you invest that again in San Miguel. Because you assume that at the start of the period where you started investing, that's the moment when you took the view, the long-short view, that's called. So it means basically the assessment of how much do I actually know about what I'm investing in. Okay? So after 1 year, you will again own $50,000 in Jollibee and 50,000 in San Miguel. Right?
Yes.
Good. Okay, the third strategy, tactical. Now this is a very interesting strategy and a very fun strategy as well, if you like roller coasters. So how this works is, again, you set out with a Jollibee and with San Miguel. After a year's time, you check again. Is this the optimal portfolio allocation, right? Let's say that both Jollibee and San Miguel have gone down with 10%. So, you own 45,000 in each. That's what's left. Now then, suddenly, let's say that there's a new stock coming on the market. Let's call it Morocco, right? There's a company that suddenly decides to go public. And you think it's a fantastic buy. I mean, Morocco, it's a great company, isn't it? Monopolist. Very hard to argue with. So, that's then the moment when you say, alright, this is what I'm doing. I'm going to now sell a bit of Jollibee, and I'm going to put that in Morocco, because my strong belief is that Morocco will do well for 1 or 2 years. After it's done 20% up, then I'm going to sell it off and put it back into San Miguel. That's it. That's the third one. Fourth one, dynamic allocation. Dynamic allocation means that you start off in exactly the same fashion, so 50% Jollibee, 50% San Miguel, but things change. So you actually don't think that after a year's time, if one stock has gone down a bit, so if Jollibee has suddenly decided to introduce healthy menus, then you say, alright, now I think that Jollibee is actually fundamentally a much better company, because they're better managed. They introduce healthy menus. San Miguel is not a good company, because their management doesn't understand that people don't like drinking beer. So it means that I'm going to sell off some of San Miguel, and I'm going to put it in Jollibee, even though perhaps the San Miguel stock has not tanked. Okay? See the difference? Yes? Alright. Now, then there's one fifth strategy that is actually the most interesting one, and that is insured allocation. Insured allocation sounds very safe, very secure, very nice, right? Why it is nice, I'll tell you in the rest of the talk. The key is that you basically start off with a similar sort of portfolio. So you say, okay, I'm investing 50% in San Miguel, 50% in Jollibee, but in addition, I know that these are stocks and the value can go up as well as down. So I don't want that. I want to be looking back at my investments in, let's say, 1 or 2 years' time, and I want to understand that I have, I have made some return at least. I want to have that guaranteed. So that means that another portion of your portfolio you have to put in, let's say, bonds, right? Or it can be anything else. It can be a very high dividend yielding stock. Morocco would be a good example. Are they paying dividends? Morocco? They are? Okay. So normal utility company, like any other. Good. So you then say, I want to make at least an X amount in dividends. I am very certain that Morocco is, for example, paying a 10% dividend yield. So that means that they pay 10% of the current stock price in dividends each year. That, of course, dividend yield is going to go up and down, right? I mean, as the stock price goes up and down. And as a result, I want to be able to tell my clients that I made for them, out of their 100,000 in savings, I want to, for example, tell them that they made at least 50,000. If the dividend yield of Morocco is always 10%, then you get, of course, how much you need to put in Morocco, right? How much you need to put in Morocco? I'm not hearing any answers, guys. Financial advisors, no? How much? Oh, if you want to tell your client, are you a financial advisor?
No. I'm
No?
a journalist.
Who's a financial advisor again? I'm not so cool, guys. I'm not so cool. The right answer is $50,000, right? $50,000. If you want to tell your client, okay, sir, ma'am, I made you $5,000. Yield on Morocco is 10%, so 50,000. Yes. Diba? Good. So the rest of your portfolio, what can you do with the rest of your portfolio with the other 50,000? You invest them in Jollibee, something well, money market funds, more Morocco, the same? SM, investment SM? Why SM? It's money, good money, yeah? Okay, that is a view, you can take. The key point is the rest of your money you can put in stocks that give you a return that's absolutely unlimited. The limit of the stock is only limited by your imagination. That's it. Exactly. So that's in the end a quick overview of the 5 broad portfolio allocation strategies. Okay. Now we've had the theory now. I hope it wasn't too boring. Now let's think about what basically, what is important for you, right? What is important to realize? If you're a financial advisor, how should you go about managing your asset allocation, and more importantly, I think the question is, how do you make your clients happy? Is that right? So, let's see. Exactly. So, what is it in practice? So we've had the theory. What is it in practice? What do you think? What should you do before you go out thinking of these asset allocation strategies? Am I going to put my money in Morocco, Samuel, SM? What is the first question you should ask?
You should know the objective of your client.
Very good, sir. Excellent. You're not a financial advisor, you said. You should become one. I think take a CISI course, and then it's.
I blog on business and finance.
Business and finance.
I blog on it.
You?
I blog.
You blog.
Yeah.
You blog. Okay. All right. So that's anything. Okay. No, then that's no, but it's the right answer. You've got it right. You need to understand your client, right? So the key question is asking, what is the client looking for? What does he want to achieve? So who is a financial advisor? Don't worry about it. I'm not going to make it too nasty. Anyone? Really? Okay, sir, can I ask you the question then? What are certain questions that you think that financial advisors could ask their clients?
should ask for their aspirations. Should ask for their aspirations, what they wish to, what's their vision of their future, their life, what they want to achieve, their dreams. You have to really be concerned about their dreams and aspirations.
Yeah.
Exactly. I think you've got exactly. You hit the nail on the head. That's exactly right. The first conversation that you should have with the client is always, what do you want? What do you want with your money, right? What do you want out of it? What is your investment objective? Very important to also understand some of the personal aspects, right? Is this person having a family? Are they saving up for a house, a car, real estate? Key. Very important. Very basic. So what are some of the things that a client could be looking for?
The yield.
What will my money be in 5 years or 10 years? What will be the yield or interest for so many years? Will it be a short term, long term, mid term, something like that? If I'm for investments, on my retirement, am I assured of my good retirement income? Depends on the protection, education, or income protection.
Yep.
So on those 4 aspects, you ask your client like that.
Yeah.
What is his priority?
Yeah.
Something like that.
Yeah, I think that's exactly right. So, that's indeed the question you should ask, but some of the answers, right? So you said in 5 years they want to have maximized their portfolio, is that right?
Yeah.
Yeah, okay. What else? Are there any other, or who has encountered a client saying anything else from like 5 years, maximize my money in 5 years, 10 years, 20 years? Is there anything else that they could have? Who set risks?
Client would be asking what are the risks in my investment.
Right, so he asks for what is the downside, right? So most likely the client is very scared of risk, right? He wants to really minimize a certain amount that the portfolio could fall with. So what sort of, I'm getting a bit ahead of myself here, but what sort of portfolio do you think he would be choosing? Out of the 5 that we just discussed.
It depends on the type of investor he is. So if he's risk averse or if he is an aggressive investor.
Alright, I'm hearing the right answer, in fact, quite a bit around me here. The insured portfolio, yeah? That is indeed what could be a good one for such an investor. So, tell him buy Morocco. No? Simple as that? Simple as that, really. Yeah? Okay, no, alright. It could be a good strategy. Okay. Alright. Well, so basically things I heard is maximize money in a certain time span. Other things I heard was downside protection, no? What are other things someone could be looking for in terms of investment strategy? There's quite a few. So someone could, for example, be looking to send his kids to school. Someone could be looking to, as I said, buy a condo, a car, anything else, a dog, a cat. Also, another thing that you commonly see, very commonly, is they just want to find a destination for excess cash. Right? What you see a lot, actually, in London and especially in Dubai, where I worked, is people who became excessively rich with, doesn't matter whatever it is, maybe they sold a company, they're from a very rich family, or they just did very well in any other type of job that they had, like maybe they're an artist or something, right? They just suddenly got a lot of money and they said, okay, instead of spending it on very expensive cars, on women, or on going out or so, I'd rather invest my money in the stock market. Or I'd rather save up for my kids. And that is something that a lot of people in fact do. And that is something where these people don't have a view in mind saying, okay, I actually want to have, in 5 years I want to maximize my money. That's not the way that these people look at investments. These people just look at, okay, I want to park my money somewhere and I want it to yield something. I want it to work for me. So it's a different approach. Another thing is a safety buffer, right? So it could be someone who has a nice amount of savings, maybe he inherited it from his parents, but he didn't really go into the same business as his parents. So it means, this person just wants to have a little apple for the thirst when things go sour. And he said, yeah, on the bank, I don't want to put my money in the bank because I think the interest is too low. So that means, okay, put it in stocks and just see what happens, right? And just make sure that it doesn't lose too much value. Another thing is supporting a certain cause. I mean, we've now mainly spoken about investing in the public stock market. But what actually if you could invest in other things? Real estate, startups. I mean, who of you has supported a startup? Who of you has invested in some money? Yes? Would you like to tell a bit about it? 1 second.
It's actually a company in the Bay Area, and it's called iFly. I don't know if you've heard of it, but it's basically a simulation tunnel for people that want to get to experience what it is like to fly in the air. So it pulls people up, and it's also a training facility for people that want to learn about skydiving, pilots, etc. And they started that in Florida, and now they have franchises all over the US. Quite popular in the Bay Area with all the high-tech companies.
Thank you. That sounds excellent. Yeah, that sounds like a great company. Has it done well?
Yeah.
Yeah. You happy with the return?
Yeah.
Dividends? Yeah. Okay. Oh, so you've seen some money back?
Yes.
Excellent. Very good. Great to hear. How did you come on the track of that company?
Two friends. Initially, were friends of ours that participated in it. But in the meantime, the leadership has changed, and it's actually doing quite well.
Okay, thank you so much. Well, so that point proves that there are other things that you can invest in, but also, I mean, the point I was looking for is there can be other reasons why people are investing in certain assets. It's not only to maximize or optimize certain returns. It can also be because someone just wants to support a certain goal. No? What if, for example, someone is someone who is an artist, a very successful actor? Who knows actors that are very successful? Loads? Lots of celebrities in the Philippines, no?
Local?
Either local or international, doesn't matter. What you often see is that these guys don't invest that often in projects from a perspective of, okay, I'm now going to maximize my money. They invest in projects because they think it's interesting and something deserves support. And these are also, if you think about it, this is not just giving money, right? This is not just giving money because you want to support the cause. This is also a rational investment decision. If you think, who knows Ashton Kutcher?
The actor.
So it's actually, Ashton Kutcher is one of the biggest Bay investors right by now. And he started with just his own money that he earned from his acting career. And after a while, he went to invest in, I think it was Facebook. He was a medium stage investor in Facebook. And of course, he's done very well with that. But the reason why he invested in Facebook was not because he wanted to make a quick buck, or he thought it was a very wise investment decision. He just saw a team, and he thought, okay, I want to help these guys. I want to give these guys cash. And I'm rich anyway, so for me, a few million more or less doesn't matter. For me, it's all about just the support, right? So it's also an investment decision. Okay, so that's what the client could be looking for, right? These things. So then the next question to ask, or basically actually a conclusion is, what should you do? Always listen to your client. And that's what the gentleman here in the front row already said from the onset. You should always listen to your client before you start giving an advice. The second thing is, I think also these questions and responses were answered by the gentleman. So, maybe just to put it more clearly on a piece of paper. I mean, you said one question is, what do you want to achieve? What else? What other questions?
What is your vision of your happy life?
Exactly, very good, very good. So that means how much is a happy life going to cost you per year? No, no, it's very simple like that. Any other questions? No? What could a client be answering to these questions? What are things that you've heard? Any financial planners? What could a client be answering? I want to buy a dog, a house, a Porsche, or want to live with disposable income of at least $100,000. All these things, right? All these things are possible. So then, once you know the answer to these questions, what should you do? What's the next step?
Offer a plan.
Sorry?
You offer a plan.
A plan, exactly. That's where it comes in, the plan. So that's where you should carefully construct a plan. And as I said in the introduction, I am not here to tell you exactly which plan you should choose. Because I'm here to tell you which asset allocation strategies should work. I can't tell you that. I can't tell you one by one, you should invest in stock X, stock Y, or stock Z. Can't tell that. It's very dependent on the situation of the particular people. What I can tell you though is how you should approach it. So after you've gotten the responses from your client, the next thing you do is take this approach. First of all, you should manage your client's expectations. So if a client says, okay, I want to live with a disposable income of $100,000 or $100,000, and that should be in, let's say, 5 years' time, and at the same time, I'm putting in, let's say, $50,000 now, that's my savings. What do you tell the client? What should you tell the client that puts that scenario in front of you? Yes? No? Yes, sir, ma'am. I'm going away, I'm going to invest, and I'll see you back in 2 years' time and I'll give you an update? No, right? Doesn't work. You need to manage the expectation. You need to tell them, okay, my thinking is that looking at the stock market for the last 10 years, I know that stocks have an average yield of 5 or 6%, right? So I can back calculate how much you realistically would be having in your bank account. Then I see, how long you want to enjoy that income of, let's say, 100,000. So, you can back calculate how much does this person need to invest now. If someone wants to have a disposable income with just returns from the stock exchange, it's quite evident that someone needs to be a millionaire by now. So that doesn't work. So that's an expectation that needs to be managed. So, what expectations can your clients have? I mean, I think we've already discussed that part partially, but I think if you look at many, actually I'm interested as well from you guys. How do you find the financial literacy of your clients? Do they normally have a good idea of what their money can do for them, or not good? No? Not much? So who can give an example of a particular client? Any financial advisors here?
Actually, it depends on your clients. So first thing first, you have to know your clients. So by then you will know what they really want, and how much risk taker or are they a conservative client. So by then you can decide and create a plan for them, and then that's the time you suggest based on their question and answer that happens.
Exactly. So the question was, what do you find your clients generally well educated? Yes or no? Do you need to manage their expectations well or not? You do. You do need to manage. Yes. So how do you do it? Do you tell them it's not possible? Forget about your plan of $100,000. Yes, you tell them, right? Exactly. Yeah. Exactly. That's exactly the right approach, man. That's exactly what you do. You should just manage it, right? Be open and clear about it. Okay. So then, if you've gone through all these steps, right? What then is the best how should you go about constructing your portfolio? So how do you actually go about choosing between the Moroccos, some wells, etc.? This is how you should allocate it. It's actually quite simple. I think that, and that's why I like the insurance model the best. So the insurance composition, insurance portfolio composition, you can always choose, as a financial advisor, it's always good to manage the client's expectations and to live up to the client's expectations with the income protection part, okay? So buy Morocco for the basic income protection part, right? So buy bonds, money market funds, Morocco, high yield stocks, etc. So if you know that your client wants to have a disposable income of $20,000, $30,000 per year, make him buy the 200,000 in Morocco. It's totally sane to do that. It's totally sane to do that. And if your client comes back and says, yeah, hang on, my neighbor invested the same 200,000 in Tesla, and now he buys the same Tesla himself. Then tell him, look, I mean, you don't know that. You don't know that. Your neighbor might be having to sell his Tesla in a few months down the line and then ride a jeepney to work. So that's basically the base of your portfolio, okay? The other thing is expected upside. So of course, if a client says, yeah, but I do actually want to have a bit of risk, and I do actually want to look at other stocks here, and I do want to make a nice excess return of 5 to 10%. Don't mind if it's 0. Don't mind if it's -5. Then tell them, okay, invest in something well. Invest also a bit in Jollibee, and that's it. For the excess returns, so for a return that is only limited by your imagination, you choose other things, right? So financial derivatives, individual stock. What the madam here in red said before. So you invest in iFly. Perhaps you invest in a similar project as Facebook. Maybe you invest in Carabao Capital. So these are things you can all do in order to really make a big excess return for your client. Now, in terms of the actual assets that you should look at, right? So for the meeting the expectations assets, there I'm going to tell you now something. It does not matter at all what sort of provider you choose. So if you choose which fund provider, which stockbroker, or which person that helps you in buying these stocks, which bank, as long as the fees are decent and the service is alright, it does not matter at all. There's no one who's going to give you a better advice. There's no one who knows exactly what stocks are good or bad, or what is going to be the best choice for you in the long or shorter run. The best thing you can do is just invest in ETFs, exchange traded funds. Do people know what it is? Okay, so just take exchange traded funds on. I don't know, in the Philippines, can you invest in exchange traded funds for Jollibee or for Samago? You can?
Yes, I think.
Have you guys done it?
No, our fund managers are doing that.
Your fund manager is doing that?
Yeah.
Okay. So, okay, no, that's perfect. That's good then. I mean, if you invest your own peso for peso in some Miguel or in anything else on the stock market, most likely you're going to pay a very high premium. So that's the best way to go about it. Just do exchange traded funds. Make sure that you don't have to actually physically go to that your dollar or your peso doesn't actually physically go to the stock market. Okay, so that's pretty much it. I think I've covered this topic as well as I could. Are there any questions left? None? Alright, very clear then. Thank you very much, guys.
Thank you so much, Mr. Koop, for that interactive presentation.